Welcome to this module on spread betting versus CFD trading. Both of these instruments are popular ways to speculate on financial markets without owning the underlying assets. Today, we'll look at what they are, how they differ, and which might suit your trading style best. Both spread betting and CFD trading allow you to take advantage of price movements, whether markets rise or fall. They're both leveraged products, meaning you can control a large position with a relatively small amount of capital. However, while they work in a similar way, there are key differences in taxation, regulation, and accessibility. Let's start with spread betting. This is a way to speculate on a market's direction by placing a bet per point of movement. If the market moves in your favor, your profit is multiplied by your stake per point. In the UK, one big advantage is that profits from spread betting are typically free from capital gains tax and stamp duty. However, it's important to note that spread betting is mainly available in the UK and Ireland, not globally. Now, let's look at CFD trading, or contracts for difference. When you trade a CFD, you're entering a contract with your broker to exchange the difference in the price of an asset between when you open and close your position. CFDs let you trade global markets such as stocks, indices, commodities, currencies, and more, all from one platform. Unlike spread betting, CFD trading is usually subject to capital gains tax, but losses can be offset against profits. Despite their differences, spread betting and CFDs share several similarities. Both are leveraged products, meaning small market moves can lead to large profits or losses. Both allow you to go long or short, that is, profit from rising or falling prices. And both give access to a wide range of assets like forex, indices, commodities, and shares. Here's where the two products really differ. With spread betting, you stake a certain amount per point of movement. It's classified as gambling in the UK, so your profits are tax-free. With CFDs, you buy or sell a certain number of contracts, and your profits are taxable under capital gains rules. However, CFD losses can be used to offset other taxable gains, which is not possible with spread betting. So the choice often comes down to your tax situation and where you're based. Tax treatment is one of the most significant differences. In the UK, spread betting is exempt from both capital gains tax and stamp duty. CFD trading, however, is subject to capital gains tax, but that also means you can offset losses against other profits. Always remember, tax rules can change, and they depend on your individual circumstances, so it's worth seeking professional advice. Both spread betting and CFDs involve leverage. This means you only need to deposit a fraction of the trade's total value, called margin, to open a position. While leverage can magnify profits, it can also increase losses, sometimes beyond your initial deposit. That's why using stop losses, risk limits, and having a clear strategy are absolutely essential. So, which should you choose? If you're in the UK and want tax-free profits, spread betting might be appealing. If you're outside the UK or prefer a more flexible instrument that's recognized globally, CFD trading is the better option. Your choice should depend on your location, tax considerations, and trading objectives. To wrap up, spread betting and CFD trading are two powerful ways to trade global markets using leverage. They operate similarly but differ in structure, regulation, and tax treatment. Before trading either, make sure you understand the risks involved and always trade responsibly. Thanks for joining this session.